a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
We're going to talk about some top-performing tech ETFs now with our ETF Research Director, Nina Mishra. So tech has been overall a top-performing group so far this year, in spite of the fact that there are a few of the big tech companies that are weathering some issues right now.
Yes, Facebook shares have been pounded this week, earlier this week, after it was revealed that Cambridge Analytica, which was a company related to Trump campaign, stole information related to 50 million Facebook users. Yeah. And Facebook led the tech sector lower on Monday. Other technology stocks were also pounded that day, though they have rebounded on Tuesday and today. But despite this sell-off on Monday and continued sell-off in Facebook shares, tech is still the best performing sector this year after a 38% return last year in 2017. In 2018, this year so far, the technology sector is up about 7%, whereas the broader market, the S&P 500 index, is up just about 1.5%. And despite this continued outperformance for the past couple of years and this year as well, there are many reasons to, I believe, stay positive on this sector.
Okay.
Now, the first one is strong earnings growth. According to Zacks earnings trend, for Q4, 88.5% of tech companies reported better than expected earnings, and more than 85% reported better than expected revenues. That was great. And for this year, sector earnings are expected to be up more than 22%. Another reason is that many technologies companies, because they have been like profit-making machines, so they have so much cash on their balance sheet, and they have been returning a lot of cash to shareholders in the form of dividends and share buybacks. And with tax reform, many of them are bringing cash home. And with more cash at home, these companies will be probably increasing their share buybacks and dividends and investments. And also because they have so much cash and low leverage, so technology companies are less vulnerable to rising interest rates also. Then there are so many new growth drivers for the tech sector as a whole, like the Internet of Things, artificial intelligence, big data, mobility, cloud computing. So with so many growth drivers, I think earnings growth is likely to continue going forward.
So some good, bottom line, some good tailwinds for tech companies.
Yes.
All right. So we have 3 different tech ETFs that you say are up more than 15% this year.
This year, though the broader tech sector is up about 7%, they have more than double return of broader tech sector. These are the top performing tech ETFs, and they are all very unique. All 3 are very unique, and 2 of them are rather unknown. Not very popular, known to investors. So let's take a look at them.
Yep. So the first one is the Spider S&P Internet ETF.
The ticker is XWEB. It invests in internet retail and internet software and services company. It's a modified equal weighted ETF. Now, as I said, AUM is low. It has just about 4 million in assets under management. Expense ratio is 35 basis points, which is not too high for a specialized ETF. It's up 17% year to date. Now, if you want to take a look at this ETF for the details, you should go to the quote page on Zacks.com, and also through the external homepage link, you can go to the fund provider's website and you can look at the holdings also. So if you scroll down and here, one second, yeah, here are the holdings. So you will see a lot of, as I mentioned, there are internet retail and internet software and services companies. So those kind of holdings you see over here, a lot of internet software companies, Nutanix, and also internet retail companies like Box, Zillow, and Match Group. This, as I mentioned, is up about 17% this year.
All right, and then we have the Spider FactSet Innovative Technology ETF.
The ticker is XITK. This holds high growth companies, very innovative companies with high growth potential in technology and electronic media sectors. This is also an equal weighted ETF, and this is good for these smaller ETFs, because when you invest in your new high growth companies, they are risky as well. So equal weighting kind of almost eliminates the single company risk, or largely eliminates the single company risk. It has about 9 million in assets under management, again rather unpopular so far. Expense ratio is 45 basis points. Now this one is up more than 16% in 2018. And looking at the holdings for this one, you can go to this sponsor's website through the link on zacks.com code page, and you can look at the holdings and other details. And as you can see, this has technology as well as electronic media companies. You see some ADRs also, as here, some foreign companies listed which have ADRs listed in the US.
Okay, and then finally, First Trust Dow Jones Internet Index.
Now, if you remember, we had discussed this ETF when we discussed top performing ETFs of the 9-year bull run. This was one of the top performing ETFs, up more than 900% over the past 9 years. So this is rather well known compared to the other two. It holds largest and most liquid US internet companies. Assets exceeding 7.3 billion. Expense ratio is 54 basis points. This is up about 15% year to date. And if you look at its holdings, you will see that it's, first of all, it's a market cap weighted ETF, and Facebook is among the top holdings.
Oh.
Amazon is the top holdings with a 10% exposure. Facebook has about 7.8% exposure. So again, its performance is going to be somewhat impacted by Facebook. We'll see how Facebook performs going forward and what kind of steps they take to avoid these kind of occurrences in future. Now, since we discussed two very low AUM ETFs, I wanted to highlight some of the issues related to low AUM ETFs.
Okay.
So first of all, because they have very low trading volumes, they are not traded much, so that means their bid-ask spreads could be high, and it makes sense to use limit orders in this case to reduce your trading costs. Do not use market orders, use limit orders for very low AUM and low trading volume ETFs.
Okay.
Secondly, because of low AUM, closer risk also remains high. They may be liquidated because they are not making money. Now, closer doesn't mean that investors will lose their money. It just means that you may receive cash and unintended tax consequences, and then you have to, invest that cash again. And one more point I wanted to highlight is that closer risk is also related to strength of the issuer. Oh. So a strong issuer with many ETFs which are making a lot of money can manage to run some unprofitable ones also. In this case, the two that we discussed are issued by State Street, which is one of the top ETF providers. So I would say closer risk for these two ETFs is somewhat low compared to, say, closer risk of an ETF, which is issued by a provider which has just about 2-3 ETFs. So those are the points investors need to keep in their mind while if they decide to invest in these ETFs.
Okay, makes sense. So how do these ones all stack up?
So on this chart, I have 1 year performance of all these ETFs that we discussed, and I have compared them with the broader technology ETF and the broader market S&P 500 ETF. So you can see over the past 1 year, all three are up about 50%, great performance, whereas the broader technology ETF is up about 31%, and S&P 500 ETF is up about 17%.
Okay, do you own any?
I do not.
All right, thank you for that. Don't forget, more ETF information always on our website, Zacks.com. In the ETF section, use the Funds tab in the top toolbar. It'll take you right there. With Nina, I'm Terry Ruffalo.